Dakotah, welcome.
Thank you, Sam.
Pleasure to have you, buddy.
I appreciate it.
The mastermind founder of Poolit.
You're too kind.
Very excited to dig in with you. I feel like there's been a couple of financial-oriented ones, which is great because it gets to expose everyone to the fact that I barely know what I'm talking about in the world of finance. So I'm excited to dig in with you, buddy. I mean, I think it's rare to see somebody have so much exposure to the typical, Wall Street landscape. So Goldman Sachs, Carlyle, what's the other? I'm missing
one big one as well. Yeah.
Coatue, yeah. I mean, all just, super popping firms these days. So being able to see all of those and, some great experience here in the world of startups. You're about more than a year in now. So I love hearing the story of, the startup itself, but also, what kind of created the founder of it. So, feel free to start wherever you like in terms of, where, if you think about any moment that kind of feels like the start of the journey for you.
Yeah. If I'm really reflective on the journey, I think it kind of starts back when I was on my way to college. I grew up in the rural South, so I grew up in Alabama, then eventually moved to outside of Atlanta. And my grandmother was from the Northeast. And she grew up in a time where there was still a lot of segregation. So, she couldn't study what she wanted in college. She wanted to study political science, but they told her you couldn't do that because you're a Black person, and she had busing and all these things. So when I came to her and said, I want to work at Goldman Sachs, in the last part of my high school career, and I want to move to New York and I want to do all these things, she said I should be a little bit more realistic about, what my expectations were. And it took me a long time to understand why my grandmother said that, because she was my biggest cheerleader, loved my grandmother. She was fantastic. But I think that some people just have a limited sense of what reality can be for them because there are so many preconditions to success in so many different ways. So for me, Poolit is my contribution to trying to solve some of that gap of what is possible for people by helping them realize a more fulsome, return potential in their portfolios. I think, as I went on and actually started to do a lot of these things, my experience were just very different than the experiences of people that were both in my family and back home. But even some of the folks that I went to, Brown with, or that I was even working at Goldman with, at a certain point, I think there just becomes such a huge chasm between this sort of investment you have access to. So while I was at Coatue, I could co-invest in Coatue funds, and then I got a private banker, and I could invest in Apollo funds and all these different places. And I came home during COVID, and for the first time saw people kind of all walks of life caring about investing in ways that I had never really noticed before. Not just the stock market, but people cared about alternatives to the stock market. I think a lot of them expressed that through crypto, but there were other things as well. And I kind of saw all these platforms out there that were, trying to offer people alternatives to the stock market. And what I kept seeing was that there was a gap where some of these really highest caliber firms, like some of the places that I've been working at, weren't really as accessible to people even through some of those platforms. And so I decided that I would try to figure out how to fix that. And that's kind of where Poolit really begins.
Yeah, that's fascinating. So I'm very curious what it was like. What did you expect, not expect, just starting out in the industry? That's kind of a birth by fire, crucible, if you will. I think these days it's maybe a little bit less than maybe in the 90s or whatever, when they're just burning through kids. But I'm sure it's brutal for all kinds of reasons. So what was kind of most surprising? You get to Wall Street, you've been crushing it all through high school and college, and you kind of get the dream job. What was it like when you enter the dream?
Yeah. I think the biggest sort of revolution when I got there was that it wasn't really about the numbers. It wasn't really about everything I saw on TV or that people kind of gossiped about when we were in school or something. It was really, what I saw was that the people who were really good at their jobs and the people that went the furthest were people who took numbers and told a story, and fundamentally were more analytical about industries and sectors and companies, and were just extremely curious. So I thought that I would have a harder time as an investor because I thought something was so important. It's funny, when I was at Goldman, I said I would never join a hedge fund. I kind of thought that there was no way. And I studied political science when I was in college, and I guess I just thought that there was no way that I would be able to do the quantitative rigor of working at a hedge fund. I don't know, I must have been thinking about high-speed trading or something like quant hedge fund or something like that. And when I got there, and as I got other places like Carlyle as well, I realized really what the value add is all of this other sort of perspective that you bring. And so that was the biggest delta for me. You have to have the toolkit, but the toolkit can be applied in a ton of different ways. And that is really an important. The curiosity is super important as being an investor.
Yeah, it's an interesting thing entering the workforce in areas where there's like a lot of smart people, which is, in college and high school, kind of being used to being one of the smarter kids. Then you enter the big world, and it's like there's another big filter, and you get just like some of those brilliant people alive that you get to work with that have the advantage of doing it for 20 years, and it's almost bewildering. But then also the flip side of that coin is like there's all these crazy important things that are run by people that just like these average Joes, and so it's strange, because it's like you get access to all these like brilliant people that you work on hard things with, but also like hey man, it's just people at the end of the day too,
people are people.
that run. Yeah. So you're going through doing a lot of exciting work on Wall Street, doing interesting things, coming back and seeing that the access to great investment vehicles or investments themselves is challenging. And where did you go from there? How did you go about, what was the first, second step in terms of that ultimately became Poolit for you?
Yeah. So first I said, okay, I have a great bench of people who already have a good idea about what this landscape looks like. Coatue is a large place as far as AUM, but in terms of actual relationships, it's super small. Like when I first joined the hedge fund was like 15 analysts. And so I was really close with Thomas, who's one of the co-founders over at Coatue. And so him and a couple of other partners that did more on the venture side, I was on the hedge fund side, I kind of went to and I said, look, I have this idea about this platform. What if, let's dream the dream, as we like to say, like, what if I could get places like Coatue and Greycroft and all of these other great places and put them on some sort of platform? Like, do you think people will be interested in something like that? And more importantly, marketplaces have different dynamics. This one is a very supply-led marketplace. So I first wanted to make sure that like actual great fund managers would want to get on platforms like this. And so, Thomas was really helpful, and all those other partners were super helpful for me getting access to some of those founders of funds and really starting to kind of see that demand existed there. And also getting a little bit more under the hood of like how IR works today, how people distribute through private banks and what those fee structures look like and like what's the downside for firms. And so I got a better sense of the supply side and the pain points for folks on the supply side, which even for large funds, there's a lot of them, especially like in the world we live in today, which I can get into, but started there. And I knew that because, or at least my hypothesis was, because this is such a supply-led marketplace, if I can feel good about the supply side of this marketplace, then I have enough fodder to go and focus on this full time and raise money. So I went to HBS after leaving Coatue. I said, I kind of decided to go and work on this full time. They were super supportive, and I started to build out other moats around how I would get that supply side. So I decided, instead of building a huge investment team from the beginning, I would partner with this outsourced kind of CIO investment advisor entity. Think of an entity like a Cambridge Associates. And so started working with them, started talking to more and more funds so that I had a better sense of who would give me any sort of allocation. Then once that was fully under wraps, and I also started talking to lawyers, like took my bonus from Coatue and let me talk to a bunch of lawyers and figure out what the fund formation side of this looks like. So once I basically had everything locked in place such that all I needed was the money that I raised to go actually execute the supply side, I felt good about doing it. So I raised the seed round in my first semester at HBS, and I left, started hiring a team to actually build the product and start doing the demand side, actually going out to customers and doing customer acquisition. But that's kind of how I went from step one through, I guess, where I am today.
Yeah, I think that insight is very important. I less of a stranger to the financial platforms than most, and I could tell there's so many people I think that want to build all the features that they want rather than making sure that the critical side of the network is actually well serviced. So I mean, it's interesting. So what was that like in terms of raising the seed round? If you had to go back and do it again, or give your advice to somebody in terms of raising a seed round, which is possibly one of the hardest ones to do, what would you recommend, or what would you have maybe done differently?
I'm a super adamant person about not using personal networks to get me to a lot of places. So it's not like I called everybody that I knew at Cotu and said, hey, can you help me raise a seed round? So I basically did everything through pretty cold outreach, because I also didn't work in the venture side of Cotu. I was in the hedge fund. So I think, what I would say is leverage your resources more to the extent that you have them. I probably could have leveraged people to be more helpful with warm introductions, and that probably would have been really helpful. I also went through iterations of the presentation. I think, look, there's a lot of people who will just give you good structures of how to do the seed round deck, or just get as much advice as possible. I guess there's a lot of advice on the internet. There's a lot of people who would just speak to you if you reach out to them on LinkedIn. So I think just get as much of that as possible. I would also say that it helps if I have some other particular circumstances that made mine interesting. I had no co-founder. It was just me. I'm not technical at all. I was there was a lot of founder market fit, but there was no real guarantee that I could go recruit a team to build any sort of application. So I think people, you either need to have more of your team in place, or you have to see extreme founder market fit. Something seems really, really like it's going to go right for this founder in this market because of some insight that they have, or a connection to that market that they have. And I would say, the biggest thing is also, you just have to really keep slugging at it. I mean, especially when it's so early, it's really anybody's guess how companies will do. You have to get money so you can go and execute and do all of these things. So try to provide people as many proof points as possible, but also expect that even for the most amazing company in the world, it's going to be difficult because you're so early. People are really taking a bet, on you. And especially when you're a first time founder, and I can think back to all the things I've learned over the time since I raised that seed round. You don't know everything, right? So you have to figure out who's going to be willing to take that bet on you, but you should also not internalize too much of the feedback, and don't let any of it get you down. I think if you just keep slugging, you have a good idea and you really can execute, people will usually migrate to you, even if it takes some time.
Yeah, I think that's wonderful. Every single person that comes on here says something to the effect of you just got to keep going. You know what I mean?
Every day.
You just got to keep going. So you raise this seed round while you're at HBS. You do probably what HBS wants you to do and drops out. And you go out and start recruiting a team. Tell me a little bit about what that was like. I imagine at this point it's first time managing people full time type of deal.
Yeah, it is. It's true.
Yeah. So, pair that with being first time founder, first fundraise, first big team. I'm sure the management was a lot of fun. What would you, how did that turn out? And, the management side is always fascinating to me. So, if you go back and do that again, or, what was the story there?
Yeah. So I was a big believer, coming from some of these spaces in finance, people don't always post jobs. They kind of go find people and tap them to come do jobs. And so I said, okay, I'm probably going to take a similar approach to this company I'm building and try to, mostly zoom in early on personal networks and also company backgrounds that I know what it's like to work there. So I brought on a guy named Tashar who, leads all of our engineering team, and he was a VP at Goldman, and he was at Goldman for 10 years. So I knew if somebody worked at Goldman Sachs for 10 years, what that meant, in terms of their work ethic, and that it would be similar to mine. I mean, I've been working in pretty intense places to work for a while. So you also have to find people who are a good cultural fit for those things. So I think the mission really resonated with a lot of people because at the core, it was a lot about financial empowerment and economic, equity is really what I do this for. And so I think that resonated with a lot of people. I certainly think that you have to really go find people who are a good mix of mission driven, but also that they are going to execute really intensely and that they are, big practitioners of that. I think what happens sometimes is that you may think the best thing to do is to go out and get somebody who's so experienced and has 20 years of experience doing XYZ thing. But when you're a small team, everybody has to be a Swiss Army knife and fit so many different roles. So I think, I had to learn through management also that sometimes when you hire people who are incredibly senior, it's not always the perfect fit for the early role, right? So you have to kind of think about where's your team today versus tomorrow. I also think that you should be slow to hire people. So we leveraged a lot of contractors on the engineering side early on to help us ramp up really fast. It was mostly to help us ramp up really fast, but I'm happy about it in retrospect. And we even do it when we hire people now. Sometimes we'll say, if the person's not working, if they're working, we'll give them a full-time offer because they probably won't stop to do contracting for someone for a while. But there's a lot of displaced people in markets right now too. And I think what happens is that, it's good for everybody to feel really good about the people that you hire, because the thing I never could have anticipated is the the incredible honor, but also weight that you feel by having people who entrust you with their futures. When I hire somebody, it's like a very serious thing to me because that person is my partner in building this business. And I need to feel like I can be as committed to them as I'd want them to be to me and to Poolit. And so, being slow with the hiring, making sure you do lots of reference checks. There have been people who, like our general counsel, worked at Poolit for about a month and a half, contracting. He was before he came on full time. I think people should embrace that model a lot more because it just creates better alignment, I think, on all parties. But it's been a great team. I mean, I was able to pull like a guy that I used to go to high school with who ended up working at the Yale Endowment, and he was, has been leading our investments and some of those partnerships that we do. The former chief growth officer of Tumblr was also on our team. So there's just a lot of, or he was the former CMO of Tumblr. He's our chief growth officer. So we just got a lot of really great talent to come through the door. I think they all resonated with the mission. But the key things from a management perspective to remember: hire slowly, be super methodical about it. Be conscious that early skill sets are not always the same things as skill sets at like a Series B company or further down the line. And I think the other piece that you have to do is, there's a lot of debates about this in venture communities about, when you're founding a company, how do you balance with your mental health and how do you balance with all like your time pressures? I think even though it was my first time doing this, something that really helped me a lot was having worked in a lot of environments where I have to run the whole process, right? Like when I was doing these investments at Coatue, I was the person who was responsible for X amount of names in our portfolio on the hedge fund. I'm responsible. Like if I was on vacation, I'm still responsible for those particular ones, right? And the stock market operates when it operates. So I think there's a cadence and there's a pace to the quick wins and fast execution you have to do when you're early in a company that they're like necessary components of the experience. And I don't know that there's always a good way to balance them. So keeping people motivated and keeping yourself motivated in the midst of what has to be insanely fast execution, that is also quite taxing on you as a person, I think is also really a new dimension I didn't necessarily expect, but was prepared for through other things I've done in life.
Yeah. A little bit of the hardened by fire a little bit. I think it's always, I don't know. There are a few people that, just have this super easy breezy, life and first few jobs and then become a founder and just crush it. I mean, yeah. I don't know that I've ever seen it, honestly. So you've got this great team that you've assembled and you've built out something rather fantastic. Maybe give us a little background. Obviously it's a financial platform providing access. Could you maybe explain it like I'm five and what it does and what you guys are building?
Absolutely. So I think about our product as two parts. There's like the investment product and then there's like the actual technological product. So on the investment product side, what we're doing is we're making portfolios for people in different asset classes at the highest level. We're starting out with venture capital and private equity. We also have on our roadmap and are in the process of doing hedge fund product, private credit products, and a bunch of other things across the alternatives landscape. And basically what we do is we go in, we work with our investment advisor, who's like a $2 trillion scaled 40 plus year institution that allocates for endowments and those sort of players. And we basically go find all the funds that are raising in market. They get a lot of access because of how scaled they are. I know some people from my own network. We bring them together into a pipeline and do the traditional institutional sort of diligence process. They'll fly to these managers, meet them in person. We do the DDQs, everything that you would expect. It usually takes about 2 to 3 months. And then we pick, maybe they'll see 500 different firms in a year and maybe pick 30 of them, let's call it. And so similar kind of statistics kind of flow down to us. That's what we do. We structure the portfolios and we provide them to people. Other elements of those portfolios for the structure that we use, they have liquidity after the first year. So private assets are by definition pretty illiquid. So you want people to really know that going in. But there's this liquidity upside scenario where if an incremental person wants to come out of a fund, then you can bring somebody in, you can swap those out. The shares are also instantly transferable between people. So you can always have a liquid secondary marketplace that you don't always have when you're doing a regular LP interest. And so those are kind of like some characteristics of what those funds look like. And that's sort of the structures. And then on the technological product side, we're doing a couple of things. There's a web portal. So you can go on the website and actually like browse through these different investments and make your investments. You can do all of your subscription documents and KYC all through a Plaid integration that we have on the app. On the website. We have a mobile experience on an app that's the same thing. So you can do it whichever way you choose to. And then we also have like integrated with our fund administrator. So all of the reporting is done through the app. We've integrated with a banking as a service partner. So you can move money through the app. So all of these things are kind of solved. It's like a one-stop shop for the investing that you want to do in alternatives basically. And so that's what Poolit is today.
That's pretty fantastic. So, tell me about some of those first processes that you guys are running in terms of the diligence side. How did you go about structuring? What was ultimately going to be your criteria? Obviously with the benefit of great experience and a great team, but thinking about, hey, how are we going to choose is always interesting. And so how did you structure the criterion review process to kind of match that? And, then what was the experience kind of doing those first few iterations through that? And did that change your criteria or approach?
So we kind of adopted a framework that, Nicholas, who's been running our investment process, like had at Yale Endowment. And also our investment advisor also has, there's a couple of different dimensions. There's the track record. So obviously you want to make sure that people have deep track records and good returns. You want to look at things like the people aspect. So like, do they have good succession planning? Because this is a long-term investment. Who is the partner that's leading the deal? What is their background? Which deals have they done very specifically? You want to look at things like loss ratios, right? And when you're looking at the more numerical side, there's also a part of like, what is their valuation methodology? Can we trust that the numbers that come through every quarter are right, such that we can strike a net asset value that we feel good about people, buying in at over time? You also have to look at things like, are they going to be willing to let you have the granular detail about their portfolio so that you can feel comfortable about reporting for your underlying investors. We also had to do things like look at their operations and stuff on the back end. So how do they do operations? Do they have good cybersecurity? Like all of these sort of risks that can occur with any sort of financial institution, you also factor in. And then there's like on-site where you also get to further diligence these things. But this is generally sort of the framework that we use. We also look at things like fees, see if we can get fee breaks for these different underlying funds, which sometimes we are able to secure, which is fantastic. And also put those fees in the context of the industry. So we benchmark them. I think this process is pretty standardized for most institutional investors. So it was easy to come up with that kind of criteria. And it hasn't really changed because Makita, who's this advisor that we leverage, has been doing this for like 40 years. And so it's a pretty tried and true method. I think for us, what we had to think about are other considerations like, okay, maybe for example, this fund will take us as an LP, but we want a bigger check size because we end up fundraising more, then we want to be able to flex up. So maybe you'll go to a fund that's a little bit bigger and have one of those in your portfolio because you want the ability to kind of do this portfolio construction and management. You also have to balance other things like when are they closing the fund, right? So there's an element of chicken and the egg with us ramping up our funds, but there's also an element of wanting to pace out the deployment of capital. And so maybe if you have all these great funds raising at one time, maybe you can't deploy, appropriately or responsibly so much in that one period of time. So there's just all these factors to kind of trade off, I think, that are really, really important. And that's kind of how we've been doing it.
Yeah, I get the sense that you guys are more focused on team and execution track record than anything kind of like strategic or macro views or strategies. Does that sound about right?
Yes, that's true. Because the way we think about it is this: you can't control who's in the market at any given time, right? Like I can't, let's say I have a portfolio and I want it to be half early stage and half late stage venture. What if only early stage venture firms are raising and like one really bad late stage venture firm is raising? If I'm trying to always optimize for that, that's how endowments outperform over time. It's conviction based and it's based on the best opportunities, sort of conviction portfolio versus I'm just going to optimize for these like inputs in these industries. And like, what if it's not great at the time you're out there allocating?
Yeah, I mean, if you're doing, that original allocation, I think that's the honest way to approach it. It's like, look, we're going to look at the best opportunities, regardless of what it looks like. Yeah, I think that makes a lot of sense. So do you have any sort of, everybody looks at like active share, right, of what's going on. So like, even though you're looking at best opportunities, best managers that are out there, do you have any sort of macro views that flow into portfolio construction at the higher levels that you're kind of expressing a view intentionally?
Yeah, I think so. I think, the way that we do this, number one, is like which asset classes we decided to start with on the platform, starting with venture and private equity. Private equity, just look statistically, the vintages and downturns just perform really well overall. So, we expect really great vintages out of this year and also next year. On the venture side, you see similar things because of the kind of pullback on valuations. People are getting better deals. So that's obviously really helpful for boosting venture as an asset class. I think, subtly we might express some of these things. For example, maybe we might think in emerging markets, or maybe like an Asia buyout fund, let's call it, or something like that. If we have a view on like Asia macro, then maybe that will seem like a better opportunity at the time than the US-based buyout portfolio for the private equity fund. In general, we kind of stay away from having that more macro view and try to really focus on like, who's out there and really can execute in the niche that they're trying to occupy, right? So like, we try to find managers who are really, really great at executing on a specific thing versus just being very broad based. Of course, sometimes you have larger firms that just have a lot of strategies and maybe they have specialists in each individual strategy. And so there's certainly some allocation to places like that. But in general, you want to find someone who's like doing a really fantastic strategy well, and focus on that. And over a longer period of time, right, the sort of duration of a venture or private equity portfolio, you really shouldn't make too many near-term macro decisions, aside from the fact that like if somebody like we think this is a good asset class to invest in now because of this reason, when you go too far beyond that, you're not really accounting for like the duration element, because these are pretty long-term investments, so over different cycles essentially.
Yeah, I think that's exactly right. And the venture side, I'm interested, I got to follow up on that. But on the private equity side, I wonder why this strain of performance for a while now has been really interesting. And I wonder, my own probably theory is like there's got to be some part of that is maybe the IPO window right now is brutal, but over the last decade or so, it's constantly just been higher and higher and higher. And the benefits of being public compared to the improved secondary liquidity and all the private equity operators out there, there may be a negative selection bias for companies that need to go public, as opposed to folks that just continue to operate and do really well. So, I mean, I wonder if that's been a component of why private equity has done so well lately. Lately being a relative term. I wonder if that's kind of a similar view that you have.
Yeah, I think that's an interesting perspective. I mean, I definitely think that the consolidation or the ability of companies to stay private and continue doing well is something that affects everybody's portfolio and shows why people really need exposure to these asset classes, because you just can't make the same returns in the public markets that you used to with so many companies staying private longer. Do I think it benefits private equity? To some extent, the way we think about private equity is a little bit later. So, we kind of think about, mega fund buyouts and then middle market buyout funds and small cap buyouts. It's just a little bit of a different business model. I certainly think that that's benefited a lot of the growth equity sort of players on both sides, on the VC side and on the buyout side. I think it'll be interesting to see after a market reset how things continue to perform. I do think that for these later stage sort of opportunities, it's really interesting to see those in the market now, because those are the companies that are having the most valuation impact. And so, certainly we love some of the late stage sort of venture products that we see in the market right now, and portfolios we see in the market right now, because there's a really great opportunity that once the IPO window opens back up, if you have it at these sort of discounts, you can certainly imagine that there's some better performance there, just given that things have marked down so much.
Right. I imagine that you're trying to look for venture allocation where it's highly focused on, not kind of lingering vintage, where it's like it's a new allocation that's taking advantage of these lower valuations. But I gotta imagine that's kind of tough to do. What does that look like in reality when you try to leverage these decreasing valuations?
Yeah, it's all primary. I mean, we may leverage secondaries here and there to help mitigate some of the J curve that you get at the beginning when you're kind of like having to deploy the capital, and so it takes a while for capital calls. But all of it's primary, and so people are actively taking. We're looking at new vintages, new investments in funds. So we're getting all the investors on Poolit will be able to see that sort of upside from where we are today. It's not like going back to old vintages.
Yeah. It's fascinating. It's really interesting what you guys have put together. So one thing that you mentioned is that this is what Poolit is today, which leads to a great standard question here of what does that look like fully articulated for you 5-10 years down the road? What are those things that you still want to turn Poolit into, or what's the ultimate articulation of what you built here?
Yeah, I think that in general, you start off with alternative investments, and there's a lot of different ways that we can continue to kind of spin up different vehicles that cross asset classes. So that's one core component. But I think the overarching theme is that people just broadly have, portfolios that are not super well managed or like not fully diversified. And so there's a lot of things that we can do technologically to also help them, manage that diversification, be it tell them, hey, I think you should have this particular exposure to this alternative investment class, or look at their brokerage accounts. You can use things like Plaid or other sort of integrations to see people more holistic financial pictures for people and give them more curated recommendations. So I certainly see, Poolit becoming a lot more of like a wealth management, a more holistic private wealth management sort of platform for people. I think the thing for us is that we don't think that, technology fully supplants the need for some people to have a human. So we also partner with wealth advisors and family offices and other places to help them kind of get those insights that help clients. I think of us not really trying to supplant every sort of the whole private wealth management industry, but rather to give a technological complement. And for some people who want to manage all of their portfolio on their own, certainly they can do that through Poolit, but there are also other parts of this industry where people can get the advice that they need, and we want to be able to do that as well. But I could imagine things on Poolit in the future, like estate planning and, more specific things around tax and accounting. And just a lot more of a holistic solution for people, because today you have to be incredibly wealthy to have somebody think about all of these pieces for you. Whereas, I think we can really leverage technology to deliver a lot of those insights for people while they're on their wealth journey. And maybe they choose to eventually go to a person, or maybe they're at the point where they're with a person, and maybe some of these smaller RIAs need more of these solutions, right? So I think that's kind of how we think about it. I also think owning more of our own tech stack. So right now we integrate with our fund admin, and, have all of these external sort of third-party providers that ultimately are costs that get borne by the fund. So over time, if we can own more of that tech stack as well and go deeper into it, that's another really important element for us.
Yeah, I think it's interesting. The way I'm kind of envisioning that is, seeing your tech get implemented to make better relationships rather than maybe the idea of creating new ones with people.
Yep.
That makes a lot of sense.
Yep.
Well, this has been a fascinating crash course in the world of management of funds here. I think it's wonderful, and you've got a lot of great products out there that I think providing really interesting access to. So I have one final question for you.
Yes.
In terms of something that I usually dig into, which is if you could do it all over again, go back to yourself in those early days and provide a few words of advice. What's something that now that you wish you knew back then?
I would probably say like team, people. I think so much of your job as you keep expanding your company, you just can't be everywhere. And the rigor that you have about being everywhere is so critical to I would say to Dakotah, was so critical to you getting to where things are today. But you really have to learn and to empower your team to be partners so that you can fully be in all the places you need to be as things scale. And I think that is one of the most critical ingredients for success.
Well, you heard it here first. Dakotah, thank you so much.
Thank you, Sam.
Poolit, appreciate you stopping by.